Hello everyone, welcome again to another class with Professor Choi. Today we are going to be watching our video number 3 of my series of Investing for Beginners. Again, if you're watching video number 3, remember that you should watch this in order. So go back to 1, watch that one, and then get back to 3. So today we're going to be talking about what exactly is the difference between somebody who is a quote-unquote trader versus somebody who is an investor. And now this is usually something that is referred to specifically about the stock market. And it's really the difference between somebody who's looking for an opportunity every day versus somebody who is interested on just growing their pile of money nice and slow over a long period of time. So, a trader is usually somebody who likes to buy and sell stock on a regular basis, trying to basically buy low and sell high regularly. So somebody who's looking for a stock to say be today at $10 and then hopefully a few months from now sell it at say $14 and make money with that. So buy, sell, buy, sell, buy, sell, buy, sell, and then make money basically by these movements on these transactions. You could also make money, as I was explaining in a different video, when the stock market is going down or where the price of a stock is going down. It's called a short. But anyway, we'll try to explain some of those transactions as this video series goes by. An investor is usually a person who's looking for undervalued assets, and they want to invest on these undervalued assets nice and slowly and methodically. Now, I don't want to say that one is good and the other one is bad. In reality, everyone is a little bit of each. So in other words, if I know for a fact that I'm going to put $1,000 today and tomorrow I'm going to walk up with $2,000 and there's a particular risk to that, then I may take the deal with the understanding again of that risk. But the some of these is usually proven to kind of work over long periods of time, and some of them kind of work on the short term, but they don't work too well for everyone. Now, the first thing you need to really understand between the difference between an investor and a trader, though, is tax implications, because believe it or not, nobody really talks about tax, but at some point you got to give money to the tax man. So in the United States, every time you make a profit on something, you have to pay a tax to the IRS for that profit. So for example, if I bought something for $1,000 and tomorrow or next year I sold it for $1,200, then whether I buy it and sell it in less than a year and a day or in more than a year and a day, it depends. The taxes that I have to pay on the capital gains that I made on that depends on whether I decided to trade it or I decided to invest on it. All right. So in a very general way, if you trade, so in other words, the money that you're making is for less than a year and a day, then whatever gains you made on that, you have to pay your taxes as if it was ordinary income. So it has to go through the tax bracket, basically. If you're sort of on the high end on the tax bracket, then you end up paying quite a lot of income tax on that. And if you're sort of on the low end of the tax bracket, then you pay about the same as the capital gains tax. Now, if you buy and hold something for more than a year and a day, then sell it after that year and a day, then you will pay a tax that is fixed at a lower tax rate. And this is what it's called, the capital gains tax, currently at 20% in the US. Okay? Now, again, depending on where you are on the tax bracket, you may actually benefit or not benefit from holding something for longer than a year and a day. Again, for tax purposes only, not really for making money. Sometimes things jump and you just have to sell it because it went up too fast and you want to cash out some of that money. Sometimes you want to wait. There is no rush sometimes in the market, especially if you know that this is a solid asset and it's going to be around for a really long time. Now, if you're a trader, you like volatility. Volatility is a word that we use for basically the movement of that asset in value up and down. So if you have an asset that moves a lot in value, then that asset is highly volatile. If you have an asset that does not do that regularly, in other words, an asset that sort of grows but stays sort of in a steady direction, so in other words, we could probably make a really nice line to represent the movement of that particular stock, then this is a low volatility asset. If you're a trader, of course, you're buying to come in and out, you're trying to come in and out at different times, then you like assets that are highly volatile. Because you can jump on the lows, sell on the highs, jump on the lows, sell on the highs, sell on the high, and then do that regularly, and then you make a lot of money, if you get it right. Now, investors don't like volatile assets usually. They like assets that are more steady, that have different sort of characteristics. And as I said, neither of them is good or bad. I need you to understand that most people eventually find what works for them in the stock market. And for some people, the slow, steady approach works a heck of a lot better than the fast approach of a trader. Now, investors usually like steady incomes, dividends. A lot of stock out there, especially companies that have been around for a really long time, they pay something called a dividend. A dividend is basically what you get paid for being an owner of the stock. Another example, in a previous video, for example, I talked about the fact that Publix is a private company owned by the workers that work at Publix. If you hold Publix stock as a worker at Publix, as an employee, then Publix pays you a dividend. A dividend is basically cash that comes from the profits that the company has and it's being distributed to the owners. A public company has the ability to pay dividends as long as they have a cash flow to pay that dividend. Again, it's this money that's being distributed to the owners just for being owners. Okay? So investors like those dividends because it's a steady income that you keep receiving. Investors like a steady growth. And what I mean by that is, imagine a business that is slowly growing over time versus a business that is not growing. Investors like solid balance sheets. The balance sheet is basically the financials of the company. And investors like companies that of course have more income than expenses, they have profits, even if it's a small profit. Investors like companies that will grow slowly over time. They may not have a big profit, but they have a very big growth prospect. In a very general way, something that I always like to explain is that the value of the stock represents the sales of that company. So a company with a higher revenue over time will normally exhibit an increase in value or an increase in price. A company with declining revenues over time will also exhibit a decline in their stock over time. So companies with low debt, companies with high cash positions are usually something that investors are looking for. Now, whether you want to be a trader or an investor depends really on the level of risk that you want to take and what exactly is your time horizon for something, and a few other things. But let's explain the word risk because most people don't quite understand it. So risk is basically whether something is going to pan out the way you want it or not. So in other words, it's going to make you money or lose you money. When somebody says that something is higher risk, it basically means the same as volatile. It also means the same as saying, well, it goes up in value and it goes down in value very quickly. And we don't know in which of the two directions it's going to go. So usually, higher risk assets have a higher return. Okay? Low risk assets usually have a low return. Now these have different implications, by the way, for whether it's stocks or bonds. In the bond market, for example, if you see a bond that pays a higher interest rate, that normally means that that company is less likely to have the ability to pay. Therefore, the market is requesting a higher interest rate to lend that company money. Okay? In the stock market, when we talk about risk, it's usually associated with volatility. Okay? So high risk usually means high return. People who like high risk, they could be interested in buying and selling a lot of what we call penny stocks. Penny stocks are stocks that have very low monetary value, so you buy lots of it. Because you can buy lots of that, if it goes up by say 10 cents, you can make a lot of money because you're holding a lot of it. But it could also go down very quickly by 10 cents. Okay? So that's the idea of what risk is. A low risk asset also has a low return. So high risk means high return, but also could be mean high losses. And low risk usually means low return, which could also mean you have low losses. Again, it's kind of like the difference between setting up a portfolio that slowly performs at a particular rate versus a portfolio that does this over time and could quickly, as easily basically be downward turning than upward turning. A low risk portfolio usually has very low growth over time. Okay? So again, high risk means high return. It could also mean high levels of losses. And low risk means low return or low level of losses. Examples of extreme high risk and low risk. I don't know if you've been following cryptocurrencies, but this is really like a roller coaster ride. So you wake up one day, it's up 14%, wake up the next day, it's down 14%, wake up the next day after that, it's up 20%, wake up the next day, it's down 25%. Alright, so cryptocurrencies are very high risk, but they also have high return. In other words, if you can get it at the right time, buy it at the right time, sell it at the right time, buy it at the right time, sell it at the right time all the time, then you're going to be able to multiply your portfolio a heck of a lot faster than somebody who puts their money on, say, a US government bond, which is the ultimate sort of low risk investment. That pays, last time I checked, somewhere around 2% a year, which is really not much at all. And by the way, I'm sorry, but I did this math wrong. 2% is $20. Okay, so in a high risk asset, you may be able to kind of double your money pretty quickly if you get everything right, or you could lose all your money very quickly if you get everything wrong. In a government bond, you're probably never going to lose your money, but you're probably not going to make a lot of money either. Okay, so this is really the difference between what we call a trader and what we call an investor. And believe it or not, most people are a little bit of each. I'm one of those people that has the mentality that I want to get, I call it getting rich slowly. And it's really the way people like Warren Buffett like to explain how to trade in the stock market. Okay? So, getting rich slowly what it basically means is that what you want to do is you want to be putting money on assets that provide a particular return over time. So you have a very long time horizon for when you're interested on basically having this pile of cash and when you're going to be using it. So what you do is you constantly feed your account and then you look again for these undervalued assets over time and you purchase them and then your account value goes up nice and slow over time. If you're interested in getting rich quick, and again, as I said, getting rich quick could also mean getting poor quick, all right? So getting rich slowly usually means also, because you have a really long time horizon, you can react if you're not getting the rate of return that you want. If you try to get rich quick, it could also be getting poor fast, okay? Again, remember that it has to do with volatility. So if you do all the transactions wrong, you buy high, sell low, buy high, sell low, then you can get poor very quickly. Or if you buy low, sell high, buy low, sell high very quickly, then you can recover your money back quickly. So getting rich quick basically means you're going to have to invest more on high risk assets and then go through the roller coaster ride of that and hopefully buy at the right time, sell at the right time. While getting rich slowly basically means you don't really need to take all of that stuff into account. Instead, you sort of slowly invest and then watch your portfolio over long periods of time gain value, hopefully. All right. So again, that's today. That's our lesson for today. Video number 3. What is the difference between a trader and an investor? Thank you for tuning in to Professor Choi. Have a good one.